December 31st, things were weak. January 3rd, things were strong. What changed?
Well, as you're seeing with the earnings, it's not necessarily up and away. We still have some issues to work through. Our own indicators are still saying that there's a heightened chance of recession. But that being said, I think the thing that changed last year was a reset. So the environment today, in the long run, is better than it was, let's say, a year ago for investing. And the reason we say that is because multiples on stocks have come down as yields have risen. So for a portfolio of stocks and bonds, you're getting more yield and you're a better entry point for stocks. But the difficulty is in the here and now. So there are recessionary winds blowing. We're underweight equities in our tactical positioning at Washington Crossing, our top-down work. And when you look at the earnings, it's starting to show up there. Every single sector, with the exception of consumer staples, has reporting lower earnings or are on track for lower earnings for the fourth quarter than what was expected at the beginning of the year. So we still have some tough sledding, but for longer-term investors, we're in better shape.
Well, okay, well, you're underweight now. Are you willing to or ready to change that, Kevin, given the recent strength? So, you know what? All right, things have been turned around. The money's flowing in. Let's switch our position.
Sure. So our tactical work has led us to be underweight equities for most of the past year. And we publish all of our work on the website at WashingtonCrossingAdvisors.com. But what we've seen is that the preponderance of data has been weak for most of the past year. And directionally, that has led us to be underweight stocks. Now, even though we're underweight stocks coming into the year, I will say that in the last month, we did increase our equity allocation by the most, I think, in at least 6 months or 9 months, but still maintaining an underweight position. So it's one of those things that maybe we're starting to make a turn. And that's why we increased our equity allocation from deeply underweight to just somewhat underweight. And we'll have to see where we go from here. But clearly what we're seeing in the earnings is we're not through the other side of this yet.
Do you expect maybe not a retest of the lows, Kevin, but this strength to not last and maybe the markets to make a downturn heading into spring? Or are these the gains we've got for the whole year and we're going to flatline it for the next 11 months?
Well, it could be choppy and it could be volatile. I think as a result, what you really need to do in the portfolio is just ask yourself one question. The vast majority of strategists out there are looking for a recession this year. So you want to ask yourself the following question. If I'm invested for the long term, where the returns I think actually will be better, is the portfolio set up in such a way that the companies are going to be able to survive if things turn out worse than expected? So Washington Crossing, what we've done is focused on flexible, durable, predictable companies. And I think that's borne out to be in the way to go when there's this kind of uncertainty in the world. So yeah, I think there's some positive momentum. We have increased our equity allocation somewhat, but we're still focused on quality because the storm is still upon us. We're not out the other side yet, but valuations and yields starting out here are much better than where they were a year ago.